Welcome to GRE. I'm your host, Keith Weinhold. I'm sitting down in Pennsylvania with the governor's appointed state secretary of banking and securities. What were America's beginnings with banking, real estate, and debt? Learn how this affects you as an investor today. And what does America's day of debt reckoning look like today on Get Rich Education?
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from Harrisburg, Pennsylvania to Harrisonburg, Virginia, and across 188 nations worldwide. I'm Keith Weinhold, and you're listening to Get Rich Education. As I'm in the Keystone State of Pennsylvania this week, in just a few minutes, you'll hear my sit-down with Secretary of Banking and Securities for this great state of Pennsylvania from 2020 to 2023. The rather distinguished guest also sits on the Ivy League University of Pennsylvania's Board of Trustees. And before we're done, I'll be sure he understands at least one GRE core principle here and get his opinion on that. Yeah, I visited 7 U.S. states so far here in the past month, and I'll continue to visit so much of the United States. In fact, I might have done more driving this past month than at any time in my life. Now, some people are really car people. We have this kind of car culture in the United States. There's some evidence that younger people aren't as interested in that as older people. I mean, some people, they get really excited about new car features or new dashboard interfaces or hybrids or EVs and charging stations. You know, none of that is really that interesting to me. However, you know, the one new car feature that I actually really care about, and I'm waiting to go more mainstream, any idea? The one game-changing car feature that I really can't wait to get here because it's really going to improve your quality of life and mine. And I talked about this way back in Get Rich Education episode 13 in the year 2015. It's something that is still expected to have substantial ramifications for real estate, and that feature is autonomous vehicles, also known as driverless cars. I mean, as much of the world that's automated these days and digitized, it feels like something is out of whack to have all of this technology that you have in your car today. Yet, even if you're on cruise control out on Interstate 80, like I have been a lot lately, you've mostly got to keep your eyes glued to the car bumper in front of you. Yes, and the car that reliably drives itself, that's the new feature that I really want. I mean, imagine for you to be able to get some sleep or scroll your phone or, I know that it sounds funny, even exercise while your car drives itself. And of course, this still pretends to have a real impact on real estate. Cars will really need to be owned. It's just a subscription service that you order. A car comes to pick you up, and then it drops you off where you need to go. So these cars just continue to stay in motion out there. You don't need a garage so much. And this means that cities won't need nearly as much parking. So parking lots are less important. Parking garages are less important. And since you can be more productive while you're a passenger and the car drives itself, well, therefore, those neighborhoods that are, say, now 1 hour outside of the center of a metro area, well, those areas won't have as much of a price discount because autonomous cars lower your time expense in commuting. But autonomous car adoption has been slower to develop than a lot of people, including me, expected. I mean, there have been a lot of experiments, but see what happens is an experimental autonomous car crash, that just makes more news than a human-created car crash, and that has really slowed adoption. So, yeah, I'm not so into cars. The only feature that's on the horizon that really gets me interested is winning back some of my time with autonomous cars. Hey, we have a ton of great podcast episodes lined up here at GRE. Some of the most brilliant minds in the real estate and money world continue to join me. Coming up soon here on the show is the return of a really dynamic guest. He goes by the nickname, the mad scientist of multifamily in the industry. Some call the amount of multifamily, mobile home parks, self-storage, and other commercial real estate investors that have these floating interest rates, the amount of those people, it's almost insane. Higher rates are going to bring those deals down, and investors will keep losing money in those deals. That's what the mad scientist of multifamily and I are going to focus on them. Yes, these people that learned how to perhaps do syndications through TikTok videos, they are losing their deals. And that really is too bad, because that reputation, seriously, that hurts the good operators. So we're going to sort that out for you. Then on a later episode here, one of the sharpest economic minds in the entire world joins us to discuss why the recession didn't happen as soon as he and a lot of others thought, and what that means for the future of stocks and real estate and commodity prices. All of that is in the near future here on the show. But today I'm visiting my home state of Pennsylvania, where I've lived most of my life. It is the 5th most populous state, despite not being that large by area, and despite the fact there are still a ton of rural areas in Pennsylvania. And of the 5 biggest states, Pennsylvania may very well have the deepest history. So we'll dig into some real history today. Pennsylvania banking was influential on the formation of United States banking, including that of Robert Morris. He's a pretty well-known name, but he was succeeded by a better-known name right after Robert Morris. We had Alexander Hamilton in that banking role. But yeah, Pennsylvanian Robert Morris, he is known as the very financier of the American Revolutionary War. As we're about to discuss the nation's beginnings, America's formative years in land and real estate hundreds of years ago, look, if 100 years ago, a colonist or an early American, if he or she said this, I'm going to buy a piece of property and develop it, okay, what do you think that meant when they said that? Today, if you said, I'm going to buy a piece of property and develop it, well, most people would think that you're going to build a housing development. But back then, it probably meant that you were going to clear your land of trees and plant it for agriculture, and you're going to grow wheat or corn or tobacco. That was the discussion you were having then. What crop are you developing on your real estate? It sure wasn't, are you going to develop apartments or condos or single-family homes? That's how it might sound today. In fact, the 1790 census, that shows that roughly 90% of the American population was employed in agriculture. 90%. So your real estate income was largely derived on your crop yield, which you might use to pay your debt on your land. Let's start this interview that I expect to be wide-ranging, as we'll take it from yesteryear up to the present day. This week's guest has served as Secretary of Banking and Securities for the great state of Pennsylvania from 2020 to 2023. It is a cabinet-level agency here in the state capital of Harrisburg. He was appointed to that position by Pennsylvania Governor Tom Wolf. Today, he is managing partner of Gabriel Investments as well, based in Philadelphia. And today, he's the author of an interesting new book. It's titled The Paradox of Debt, A New Path to Prosperity Without Crisis. Welcome to GRE, Richard Vague.
Thank you so much for having me.
It's good to have you. For those of you listening in the audio only, Vague is spelled V-A-G-U-E. And Richard, as Pennsylvania's Secretary of Banking and Securities, I know that you have various deputy secretaries that assist you. Tell me, I'm going to venture to guess that that role includes acts like the oversight of banks and various consumer protections. Are they important parts of that role?
Without question. The fundamental job is looking to the safety and soundness of the banks chartered here in Pennsylvania to make sure they don't fail. And we all saw the importance of that recently when Silicon Valley Bank failed in California. And I think if we'd had the caliber of examiner out in California that the folks here in Pennsylvania were, that might not have happened.
That's a nice compliment to those that have that oversight here in state, Richard. It sure has been interesting with interest rates actually not being historically high, but at the rate that they changed and the rate that they spiked, making some things break. Anything else to tell us about that role with the oversight that you had of banks and consumer protections in Pennsylvania, and really what everyday depositors are concerned with?
Everyday depositors are concerned with getting the highest yield they can.
Sure.
And certainly they've been rewarded more lately than they have been over the last, let's say, 10 years prior to that. But they also should be concerned about the safety and soundness of the bank they deposit with. And I think a lot of folks forgot that lesson. A few years passed from a crisis, and folks aren't worried about whether their bank's going to be around so much anymore. I'm really pleased to report the banks here in Pennsylvania are in really good shape.
Richard, I don't even think that everyday depositors understand the fractional reserve lending institution system, which is really how most banks operate. And that is when a depositor gives a bank money, well, the money goes ahead and lends that out, that difference, that spread being their arbitrage, which is how they stay in business. I've got a rather interesting question, perhaps. Are full reserve banks feasible as the norm? And what I'm talking about there is banks that can't lend depositors money out, and instead that bank needs to profit by charging fees to depositors. Now, I know everyone likes to get something for free, but would that be a more responsible system? Are full reserve banks feasible at all?
If you did that, that's something I've studied quite a bit. And that was a very active question, by the way.
Yeah.
In the founding of our banking system here in Pennsylvania in 1781. It's a question that's been around forever. Any economy needs to have money created in order to grow, and the banking system is what does that now. But if you banned that in the banking system, it would just have to happen somewhere else.
Were there any prominent names that were involved with the setup of banking in Pennsylvania?
The name that you hear the most is the guy named Robert Morris, who was he was in effect the Secretary of the Treasury during the Revolutionary War. But his senior partner was the original banker in the United States, and his name was Thomas Willing. And history has more or less forgotten him. And that's, by the way, the subject of my next book. I'm in the middle of writing a biography of the origins of the U.S. banking system and our first banker, Thomas Willing.
There is a Robert Morris University in Pennsylvania, of course. And we're talking about history here, Richard, and I know that you have an excellent sense of history about the nation's beginnings in land and in real estate. Can you speak to that?
The United States was all about land from the very beginning. You had massive land grants like to William Penn to found the state in the first place. But almost immediately after the founding of the country, one of the reasons we had the American Revolution is because Great Britain prohibited colonists for owning land west of the Appalachian Mountains. And that was very frustrating to people like George Washington and others who had surveyed really lush pieces of land in the Ohio Valley. Immediately after the success of the Revolution, the wealthy investors in America began buying millions and millions of acres towards the west in the Ohio Valley, in Kentucky, in New York, in Western Pennsylvania, and the like, and got into trouble and brought the first financial crisis in U.S. history, the land crisis of 1796 and 1797, because they were buying all that land on credit, either from the landholder, the private landholder, or the state or commonwealth that the land was in. They bought this under the presumption that the value of real estate would always go up. And of course, it just didn't go up fast enough. And Robert Morris, to speak of someone, actually ended up in debtor's prison because he overextended himself, which is somewhat ironic since he's something of an icon for credit ratings and credit prudence. And yet he was very much of a wild speculator and ended up in prison destitute.
This is really interesting. Okay, a nefarious character early on in America's private real estate development when the Appalachian mountain range in the late 1700s was deemed as the frontier to a lot of people.
Absolutely. Everybody was looking west of there for the big gains and the big opportunities.
Yeah, I mean, this is part of manifest destiny and the American dream. So, can you tell us more about a lot of that land in the early days west of the Appalachian Mountains? How much did the government claim as theirs and sell to private landowners on credit? And then how much were private landowners taking, and were they allowed to make land claims and then sell it to someone else? Or tell us more about those early beginnings of that real estate setup.
Well, that's exactly right. Most of that land was owned by the colonies, which in 1776 became states. The states owned that land. The states all incurred massive debts in prosecuting the revolution itself. So by the time you get to 1783, 1787, states are deeply in debt, and bondholders of state debt are not getting paid interest. And one way to alleviate that crisis was to sell land. And selling it an acre here and an acre there wasn't going to do you any good. So the states were selling land, 100,000 acre parcel here, 1,000,000 acre parcel there. Now, the guys that bought that, at first they were thinking, we'll do it, we'll develop towns, we'll lay out the towns, we'll survey them, we'll sell them, we'll attract settlers into this realm, we'll sell it plot by plot to these settlers. But it was pretty clear that was a pretty slow way to make your money back. So they started looking to the wealthy in Europe and started sending brochures and agents to Europe to, in essence, be able to flip their land. And early on, they were very successful at that. Guys like William Bingham, who was the richest man in America, and Robert Morris, who was one of the richest, would make, 100,000 here and 100,000 there, which is tantamount to making tens of millions now. That ended. They started doing bigger speculations. There weren't the settlers to buy it. The Europeans got a little bit smarter. You had a major national financial crisis, including, by the way, it wasn't just those Western lands. One of the biggest parts of the financial calamity was in the new town of Washington, D.C., where they were moving the government, and people came in, including Robert Morris, thinking it's the seat of government. This is going to be a boom town. And a lot of folks got into deep trouble speculating on plots in Washington, D.C.
And if you, the listener, think that this sounds rather unorganized and freewheeling, of course, we just need to think back a little bit earlier as to what happened when we, as colonists, went ahead and wrested the land away from the natives as well, of course. But yeah, Richard, you talked about some of the draw and the appeal to some of the land around Washington, D.C., there along the Potomac River. But just generally, overall, in a lot of cases, this new American government, who were the land sellers trying to attract, and what were they trying to attract them to do? For example, was it to own land to set up a farm for agriculture, or was it for trapping, or what attracted people to this new land grab, if you will?
The basis of wealth early on in the United States was the crops that we grew. And that obviously, first and foremost, was wheat. And the biggest supplier of wheat, not just in the United States, but to Europe, was Pennsylvania. That's why Philadelphia became the largest city in the United States. Then just south of us in Maryland and Virginia, you had tobacco, which was our number one crop, but it was our number one export. South of that, you had indigo and rice. The further north you got, there really wasn't a lot of arable land, and that's why, places like Massachusetts had to turn to manufacturing so heavily. It was really that and fishing for cod were the only thing they could do. So, yeah, absolutely. We were a breadbasket for not just the country, but the world, almost from the beginning.
Well, you talk early on about the extension of credit and how that enabled settlers to go ahead and own some of this new land. Is this sort of the early formation of long-term mortgages? When did that occur?
Well, absolutely. Really from well before independence, one of the problems you had is that there wasn't enough currency to really facilitate economic growth. So they began issuing paper currency in various forms. And a lot of these were very successful. This was done at the state level. And what they would do is they would create land banks. And so you would go in and take your land as a farmer. You would take it to the land bank and you could get currency up to half the value of your land. And you'd pay interest on it. So it really was a de facto mortgage.
A 50% mortgage.
A 50% mortgage, and you could spend that currency. They were well managed early on. Most of these didn't work, failed, and the first real commercial bank was Thomas Willings Bank in 1781 in Philadelphia.
What were interest rates like at this time in these formative years of our nation?
For bigger transactions, the range was really just 5 to 6%. It might get down to 4, might get up to 7. Interest rates in the UK were closer to 5. In the US, they were closer to 6. There were breakdowns by a slice of an interest rate. So there wasn't an interest rate of 5.1% or 5.2%. And for high risk transactions, you could easily get into the same interest rate realm that some of our usurious lenders do today.
Yeah.
You see situations where folks in dire straits would borrow for an interest rate of 5% a month. A lot of loans in those days were very, very short term. There were the land loans that were long term. Most commercial banks made loans for 30 to 90 days. And they really were meant to bridge the period from when you as a merchandiser bought your wholesale supplies to when you sold them as goods to the folks in your town. You could roll those loans over, but they were very short term back in those days.
That is interesting. Those are really short-term loans. And this is pretty parallel with what I've read around that time, that interest rates seem to be about 5%, something like that. We're talking about the formation of this nation, its beginnings in land and real estate, and how that intersects with banking and the mortgage market, and really part of the manifest destiny and the westward expansion of the United States. Yes, we are talking about a popular four-letter word, debt. And that word debt has only become more popular in America with consumerism here in past decades. So when Richard and I come back, we're going to talk more about debt today in the United States and his new book, The Paradox of Debt. You can get that at paradoxofdebt.com. More when we come back with Richard. I'm your host, Keith Weinhold. You're listening to Get Rich Education. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. You know, I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time. So it's steady income, no surprises while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866.
This is author Jim Rickards. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with a guest that served as the Secretary of Banking and Securities for the great state of Pennsylvania since 2020. Today, he's the author of an interesting new book. It's titled The Paradox of Debt, A New Path to Prosperity Without Crisis. His name is Richard Vague. He's joining us from here in Pennsylvania, where we are together today. And Richard, I know that you have a lot of commentary about modern debt and what we can do about today's debt and how debt really seems to have expanded a lot since Nixon depegged us from the last vestige of the gold standard back in 1971. I guess really the preeminent question, Richard, is, should debt be a concern? We read all these stories about unrelatable numbers about how the United States has $33 trillion of stated public debt. What's problematic?
There's a lot more private sector debt than public debt. And I think private sector debt is the area where we need to focus and where our concern needs to be. Private debt has increased since World War II from 35% of GDP to 160% of GDP.
Wow.
So it's almost quintupled. There's about $41 trillion worth of private sector debt. That's a bigger number than the government debt number.
Yeah.
And that's globally as well. There's about $150 trillion worth of private sector debt and only about $90 trillion worth of government debt.
And what is private sector debt? Are we talking about automobile loans, credit card loans, student loans?
It's roughly divided between business and household debt. So if we've got 40 trillion in debt, it's about 20 business and 20 household. And within both of those categories, the single biggest type of debt is real estate by far.
Sure.
Within household debt, it's about 20 trillion. Almost 14 trillion of that is mortgage debt. On the business side, it's about 20 trillion. About 6 trillion of that is commercial real estate debt. So there's never been a time where real estate debt, household and commercial, has not been really kind of the driving force of the economy.
You got public sector debt and you got private sector debt. And you know, it's kind of funny, Richard. If someone asked me what the difference between those two is, there's a few different directions you could go. What I like to tell some people is, well, the government can just print dollars, okay? Everyday consumers and businesses, they don't have that handle. So the government can print dollars and they can call that whatever name they want to. Quantitative easing, maybe they want to call it currency creation. But over here, if the individual tries to do something like that, it's called counterfeiting. So yes, it can be more problematic. Individuals cannot print their own dollars at home.
Well, that's exactly right. And that's why private debt is the area that we should focus more on. If you think about the great financial crisis of 2008, mortgage debt in 2002 was $5 trillion. By 2007, it was $10 trillion. It had doubled in less than 5 years. And we all now know that was millions of mortgages that it should never have been made. That was mortgages where the individuals had no income, no job, no assets. Those were homes that stood empty for years, and in many cases, they had to get torn down.
Yeah.
If you want to look out for trouble, the place to look is in the private sector debt. And the way to detect it is wherever it's growing very, very rapidly, that's where you're going to have a problem.
So that's therefore a way to help predict economic crises. It's debt growth, or I guess you could really call it credit growth as well, right? I mean, both credit and debt are basically the same terms for the different side of a transaction. Wherever the growth in that is most rapid is really where the economic cracks are.
That's exactly right. And the fact that the Federal Reserve did not spot that in 2005 and 6 is one of the great stories of our time. They build economic models that don't even include debt as a factor whatsoever. Everybody finds that very surprising. It's called the DSGE model, and it models the future of the economy without taking into consideration anything about debt.
Why is that excluded? I mean, I'm a bit taken aback by what you just told me. I think you can tell.
It's the fact. And economists got so theoretical going back a couple of decades that they started separating out financial economy from what they call the real economy. And they just stopped studying the financial economy as kind of a secondary matter to the real economy. The real economy would be, the wheat and the automobile that gets manufactured and so forth and so on. My argument is those two things are inseparable. You shouldn't and cannot consider one without the other. And that's a huge blind spot in our orthodox economics profession.
Tell us more about how what we've discussed ties into the thesis of your book, Richard, the paradox of debt. What's the paradox?
The paradox is that debt creates wealth, but it also creates calamity. So, for example, in the pandemic, 20 through 22, government debt alone increased by $8 trillion. Household wealth increased by $30 trillion. So the money the government spends does not disappear. It actually goes into the checking accounts of households. So at the end of that 3-year period, households had $8 trillion more in deposits in their checking accounts, and the flood of new money had pushed up real estate and stock values. So cash in bank accounts increased by $8 trillion, and the value of real estate and stocks increased by 20-something trillion. So households were $30 trillion better off at the end of 22 than they had been at the end of 19. However, most of that, like 80% of that benefit, went to the top 10% of the population. And that's for the very simple reason that most assets, most stocks and real estate are held by the top 10%. It's like 65% of all the stock and real estate in the country is held by the top 10%. The bottom 60%, 60%, only hold about 14% of the stocks and real estate. So if real estate and stock values go up, it's the most well-to-do that get the benefit.
That's right. And it's really the listeners on this show that we want to help take from poor or middle class and help them understand something. You said it just a couple minutes ago, that debt creates wealth, which is a paradox to many. The title of your book is The Paradox of Debt. So here, what we often do is get 75 to 80% loans on an income-producing property where the rent income meets or exceeds all of the expenses. And this is creating wealth. How is that wealth generated? Debt. A 75 to 80% loan, debt is leverage, and leverage appreciation actually makes compound interest look pretty slow. So a very concrete example, in a sense, of the paradox of debt that we're using right here at Get Rich Education, Richard.
You have described something that is not just true about real estate transactions, but it's true about the economy as a whole. That's the essential analysis.
Yeah.
And to put some macro numbers on it, in 1980, total debt in the economy, government plus household, was 125% of GDP. Today, it's 260% of GDP.
Yeah.
Now, in that exact same time span, household wealth, net of debt, went from 350% of GDP to 600% of GDP. Debt created wealth.
Yes, those are some astonishing figures. I guess as we're winding down here, Richard, one might wonder, well, where's the ceiling? When is the day of reckoning? When do we reach a calamity? How do we know that there's too much private debt? And how does that actually look?
We have a chapter on that very subject in the book. There, it's pretty easy to see that there's an end game on the private sector side. And right now we're at about 160% of GDP. We think that's probably at somewhere in the 225% of GDP range here in the United States. When there's so much debt that the requirement to service that debt slows the economy down to near zero. On the government debt, for the very reason you suggested, that limitation doesn't really exist. The government could refinance its debt in perpetuity. As we said a moment ago, that ends up in the bank accounts of households anyway. So the thing I look to and I'm concerned about is private debt. Even though if you go flip on the cable news channels, you would think the world's about to end because of our government debt.
Now tell me, am I oversimplifying things here, at least with private debtors, everyday Americans, when an interest-only payment on your debt exceeds your ability to service it each month? Is that the path to bankruptcy right there?
You got it. And whatever you say about an individual, you can say about the economy as a whole, because GDP is really just the sum of the individuals and businesses in the U.S. So if all the individuals and businesses are approaching the circumstance you just described, the economy is not going to grow.
Well, are there any last things that you would like to tell us about your very well-received book? Because again, it's called The Paradox of Debt, and the subtitle is A New Path to Prosperity Without Crisis.
We cover the same material for the other 6 largest countries in the world. So if you read the book, you're not just going to learn about the U.S., you're going to learn about China, Japan, Germany, France, England, and India. And I think it gives you the kind of fulsome grounding you need to better understand the news stories that we get such a barrage of every day.
That's right. We need a frame of reference in putting our own more domestic debt into perspective here. Well, Richard, if someone wants to get a hold of the book, remind them of how they can best do that.
Thank you so much. Go to paradoxofdebt.com or go to Amazon or Barnes & Noble and just search for that, and it'll be right there.
Oh, Richard, you've helped expand our debt mindset somewhat here on the show today. It's been great having you here.
It's been such a privilege. Thank you for having me.
A lot of interesting history with Richard Vague today, this great state of Pennsylvania's Secretary of Banking and Securities. One concept that really hasn't changed throughout history that we discussed there is that inflation mostly benefits those at the top. Again, check out Richard's book at paradoxofdebt.com. But yes, real estate, it is still known as an inflation hedge. You still hear that term thrown around a lot, but I really try to use a different term, not hedge. I don't like hedge. Okay, in the investing world, the word hedge means something that you do to offset risks. I don't like that word used with real estate. So therefore, the word hedge, that really correlates with a defensive strategy. I mean, hedge, that's probably a better term for gold. Gold is a hedge against inflation. That makes sense to me. But where I draw the distinction is that investment property bought with a loan is not merely a hedge against inflation. That's why when I coined the Real Estate Pays 5 Ways back in 2015, the fifth benefit, it's not called inflation hedging. It is called inflation profiting. Now, if you're only looking at the overall capital price of your real estate, even your own home, well, then its dollar-denominated price alone, well, that could be a hedge against inflation. But that's only the beginning, because when you get the fixed interest rate debt with it, now you're profiting because inflation debases your debt while the tenant makes all of the payments. And then as your rents rise with inflation, the reason that your monthly profit, your cash flow, rises faster than inflation is, of course, due to the fact that your principal and interest payment stays fixed and feels really low over time. That's the inflation triple crown that I just described right there. And that's why when you buy investment property right, real estate is not just an inflation hedging vehicle, it is an inflation profiting vehicle. And today, real estate isn't just scarce, it is still about 60% below the needed supply. And then amidst that, within that, single-family homes are even more scarce. And then entry-level homes that make the best rentals are even more scarce than that. But here on the show, we connect you with those builders and providers that are making the most in-demand properties available. Oftentimes these single-family homes that are entry-level. So therefore, in this environment, if you can get a hold of those, you are going to own a scarce asset that everyone wants. That's what we help you do here. But mortgage rates have been a hindrance for adding investments, but with our referral network here, we have largely solved that problem for you. We have providers that offer 5.75% mortgage rates because they buy down your rate for you. Last week on the show, you heard how a GRE marketplace income property provider is offering an astounding 4.75% mortgage rate. And although it has some shortcomings, there are also 2.99% seller-financed investment properties that you can tie up. Yes, today. So profit from a scarce asset that everyone wants and benefits from higher inflation. And today it really tilts toward you often giving more consideration to new build properties because builders, they are the ones that are aggressively buying down your rate for you today. And new builds also have lower insurance rates. Last year, to make it easier for you, we started our free investment coaching service. So contact your GRE investment coach to help get you started. Some of our more popular markets lately are in Ohio, Indiana, Missouri, Tennessee, Alabama, Florida, Georgia, and some more. So whether you'd like to connect with the provider on your own, if that's what you'd like to do, or if you don't, you can then just utilize our service free of charge, GRE investment coaching. You can do all of that at gremarketplace.com. Thanks to Richard Vague today. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.